This is level 2 of the CFA program and the reading on intercorporate investments. I'm tempted to suggest that we all take off our financial manager hats and replace them with an accounting hat, but I don't think that would be appropriate. Let me give you a quick analogy. You ever see golfers on TV when they're playing in the wintertime and they have a regular golf cap on and then they have a knit cap over top of the golf hat? I always thought that was kind of interesting looking, although my son being a golfer, he does that all the time when it's cold outside. And so my point is that I believe that it's important for us to have both a financial manager hat on and an accounting hat on. In fact, I think these handful of FRA readings could be retitled something like, we've thought about this as accountants for a really, really long time, and the material inside of these readings are extremely important for us to use, but also for investors and wealth managers and financial analysts as well. Boy, that was a long title there, but what our focus on today is intercorporate investments, and I guess you'll get a sense of wearing two hats as you look through these LOSs. That first one clearly is the most important of the three. We're going to look at, classification, measurement, and disclosure for, look at all these things. Combinations of financial assets, investments, and associates, joint ventures, regular business combinations, and special purpose vehicles. And then we'll look at some differences because, we have US GAAP here in Connecticut, and then we have the International Financial Reporting Standards Group, somewhere else in the world. And, these two not-for-profit organizations, they look at financial statements and they say things like, we want to make sure that they're accurate, that they're transparent, that they're revealing, and that they reflect accurately what goes on inside of a business. But of course, these two groups of people are going to look at things similarly in many areas, but also they're going to look at things differently in some. So that's why we have that action word distinguish. And then we have just a slide or two on financial statements and ratios at the end. All right, a brief recap from what we learned back in level 1. Intercorporate investments are investments in the debt and equity securities of other companies. Of course, what can you and I do? You and I can show up on the floor of the New York Stock Exchange or any other organized exchange in the world, and we can buy and sell shares of stock. We could probably find some debt securities around there somewhere. Well, businesses can do the same thing. Especially corporations, publicly held corporations, can also make investments in fixed income and equity securities. And they do this for a variety of reasons. Diversification, search for cash flows and profitability, new target audiences or target markets, and then to gain a competitive advantage. We learned all about competitive advantage in the economics readings. And of course, there's a good example of an intercorporate investment. We put that Coca-Cola up there to hopefully get you to be thirsty. All right, look at that first LOS there. And we're going to take a long time to make sure we get through, the breadth of this LOS as well as the depth. All right, classification is really based on the degree of influence. If you own one share of one of these gigantic corporations, you probably don't have much influence. In fact, in the academic world, those shareholders are known as atomistic shareholders. Atom, they're so tiny that you can't even see them. So they have no degree of influence. But then, of course, as you increase the proportion of your investment inside of that company, then that degree of influence or control increases. So there are a couple of cutoffs here. Investments in financial assets. This is one classification. This is ownership 20% or less. This is passive investment, no control or no influence. Now, of course, remember that the SEC requires you to report this if you have 5% or greater. Investment in associates is kind of one of the intermediate categories where you own between 20 and 50%. So you don't have control, but clearly you have enough of an ownership percentage that you can have substantial or significant influence. So let's go ahead and define significant influence: board of director representation, policy-making decisions, interchanging personnel, and then ability to make significant transactions. I mean, it makes sense that if we're going to have a business relationship with another organization or another publicly held company, that sooner or later we may decide to buy their bonds, we may decide to buy their share of stock, and maybe we have 30% of it. So we are doing all these contracts over here, and then we're saying, hey, you know what, we own 30%. How about if we think about it a little bit differently? Joint ventures, of course, shared control between and among investors. And then business combinations, this is where the ownership percentage is greater than 50%. And so, of course, that 51% threshold simply means that in a publicly held corporation and in a privately held corporation, what that 51% owner can do is just say, hey, let's call an immediate meeting of the board of directors, and how about if I decide to vote everybody else out and vote for myself and all of my colleagues? So there's the important one, that second circle point. The investor has control. And then there's this other thing that became super popular. Maybe not popular is the right word. We became super aware of these somewhere around 1995 or 2000 with Enron. These special purpose vehicles or variable interest vehicles or variable interest entities. You know, some countries use the word vehicle, some countries use the word entity. They all mean the same thing. Of course, those of you who are following along will know that there are these special purpose acquisition companies, which are very similar here, but they're designed for a specific acquisition. These special purpose vehicles are really some kind of a legal structure so that the sponsor can, issue a bond or raise capital or put some assets over somewhere else. So look at that second circle point. I love this one here. Created to reduce risk and decrease the cost of financing. And of course, that's absolutely true. However, going back to Enron, the idea there was to mask the risk and to at least try to decrease the cost of financing. But of course, there was an explosion somewhere around the year 2000. A lot of times they're used to securitize receivables, and also leasing assets go in there. And so essentially what happens is that the sponsor takes some of its assets, puts it into a special purpose vehicle, and that special purpose vehicle then operates kind of as its own entity. All right, how do we account for investments in financial assets? Notice on the left-hand column, we give you just a little bit of a history lesson. I surely remember when I was going through the program back in the early 2000s, under IAS 39, held to maturity and available for sale. Those terms are not used at all anymore. They were replaced by IFRS 9 around 2018. And so now we have three choices. We can categorize them as amortized cost, fair value through profit and loss. And these are, I don't want to say this because these terms are not used, but if you look over there, available for sale. So now we use the term held for trading, fair value through profit and loss. You do this to kind of avoid the risk of double counting. And then fair value through other comprehensive income. And so remember that a business, it has its core function, so you take the revenues minus the expenses, you get something called, let's just call it operating income. Sooner or later, we're going to hit that term EBITDA. So maybe let's call that operating income. And that's really a measure of the quality of the product lines that the firm is generating. And I always tell students that, what's the goal of the business? Maximize shareholder wealth. One way to do this is to make something for pennies and sell it for dollars. And so that's kind of what that operating income is. But then these international bodies and the US GAAP body, what they decided was that, all right, now you've got this operating income from the core business, but there's other income out there. So we call that other comprehensive income, which includes things like, currency gains and losses, and then these investments in financial assets that we're talking about here. So let's go ahead and talk about fair value through other comprehensive income. So the securities are recognized at fair value. So that makes perfect sense. When I was back in the old days, back in my undergraduate accounting, I kept hearing this term fair value, and I always thought to myself, what might be fair to this group over here might be unfair to this group over here, but fair value is just some reflection of market value. So that goes on the balance sheet. And what we do is we throw those unrealized gains and losses over into the bottom right half of the balance sheet under stockholders' equity. And then, of course, we have realized gains and losses, and then any kind of income that we get, that's reported over on the income statement. Here's a really good summary that we put together for these three. All right, you ready for this? So, debt securities, fixed income securities, can be categorized of any of those three. However, what we need to do is make sure that those that are classified under the amortized cost method have to meet both of the following criteria: the business model test and the cash flow characteristic test. So if they meet both of those, then they'll be under amortized cost. And amortization really, from an undergraduate business course, really is a super easy concept. Of course, I'm guessing that you have some kind of a mortgage, and so you amortize your mortgage over, 15 years or 30 years. And that's super easy to understand. Part of it is interest and part of it is principal. But what if you have a fixed income security like a bond? And what happens if you pay a premium for that bond over its par value? Let's just suppose par value is 100 and you pay 120 for that bond. Well, what does that mean? How do you amortize that? How do you amortize the bond premium? And how does that relate to all these contractual payments? And so sometimes the interest income may look like the actual interest expense, but sometimes it doesn't. So you have to be really careful about that and make sure that those two tests apply for amortized costs. So remember this: the debt securities you can choose from among the three. However, most debt securities are going to fall into the amortized cost category. Equity securities, look under those two tests, held to collect contractual cash flows, contractual payments from principal or interest. None of that applies to equity, right? You might get a dividend, but then again, you might not. And there's no contract saying that the executives or the board of directors has to pay a dividend to its shareholders. So notice that that purple teardrop point: held for trading equities must be measured under the fair value through profit and loss. So that's a super important one there. Once that decision is made, then it's irrevocable. That is one of my favorite words. This I thought was an interesting one. I remember in graduate school, one of my colleagues asked the professor a question. If we buy an option today and we sell it tomorrow at a gain, do we have to pay taxes on it? How does that work? And the professor went into a big accounting story. And at the end, he said, and by the way, you don't get any information. You don't get any tax information from trading derivatives. So it's all self-reported. Now, I'm guessing that's changed. Of course, this was 30, 40 years ago. So anyway, yeah. So derivatives are measured at FVPL, of course, and that makes perfect sense, right? Because they're probably held for trading. However, suppose we're a farmer and we're hedging our commodity price risk with the corn and wheat and whatever else that we grow, and we use these as hedging instruments, then there is a special exception for that. And that makes perfect sense because you have a position in the spot market as the farmer naturally, right? And then you're hedging that risk, and so you ought to have some choices. The last one is probably important. This sounds to me an awful lot like a great question where you're reading this vignette and somewhere in the vignette someone says, oh, we're going to reclassify this debt instrument, and someone else says, oh, there's no way you can do that. And will you agree or disagree with that? And you'll have to disagree with it because it's possible if there's a business model change. Let's take a few moments working through an example here. Even though the LOS, look at that LOS, that action word up there, it says describe. It doesn't really say compute or calculate. However, you ought to be able to replicate a table here. All right, you ready for this? So here we go. Company A invests $100,000 in Company B's debt securities. So we're buying $100,000 worth of fixed income securities. Par value is $75,000, so we're paying a premium for these fixed income securities. So this all occurs on January 1st. So at the end of the year, fair value is now 150. So think about this. We bought something for 100 that had a par value of 75, and at the end of the year, the value is now 150. Of course, this must mean that interest rates will have fallen, of course. So there's the coupon rate, 5%, right? And so now look at, we say the market interest rate when the bonds were purchased was 2.5. So of course, interest rates go down, bond price has to go up. All right, so question 1, determine the impact on balance sheet and income statement if we're classified using those 3 methods. So let's do amortization first here. All right, so how do we get the coupon payment? Remember, interest payment, coupon payment, they mean the same thing. So we're going to take that 5% coupon rate that's given up in that second line, 5%, times the par value of the bond. That gets us $37.50. And of course, this is a fixed rate bond, so that's going to be $37.50 for year 1 and year 2 and year 5 and year 50 and year 100, however long it goes. But the interest income, that's quite different than the interest payment. We have to report 2.5%, which is the current market rate. That's probably the current yield to maturity on those bonds times the investment. So 2.5 times 100 gives us 2,500. And then so the amortization is just the difference between those two. Notice I did some red and some purple, so the difference there is $12.50. That's going to be an important number there as we move through the next slide or two. So at the beginning of the year, carrying value is 100. Now it's only 98,750, and then of course it goes down again, 97,469 at the end of year 2. And of course, the difference is in the interest income, which has to be less. So we're taking the same 2.5% times the 98,750, which is our carrying value at the end of year 1. So that gets us, what's that number? 2469. So you do the amortization and the carrying value right there. All right, so there we have that first line, interest income, 2,500. Reported amortized cost, 98,750, and then no effect over on the statement of owner's equity. So how about if we classify this as fair value through profit and loss? Interest income, of course, is the same, but then here, let me just go back here. What did we do? We bought it for 100, right? And it was worth 150 at the end of the year. And so the gain, unrealized gain, is 50,000 plus. Let me just go back to that 1250 there under the amortization. So there's the 51,250, and on the balance sheet we reported at its fair value of 150,000. No effect over there on the owner's equity. Now, looking at the fair value OCI, interest income is going to be the same, 2,500. The unrealized gain recognized through the profit is still going to be the same, and that's going to be recognized on the balance sheet at its 150. But then we swing that over to the bottom right-hand side of the income statement and report that unrealized gain of the 51,250. Second part of this question, let's suppose that we sell them. We actually sell them. All right, so what did we do in that previous slide? We did the unrealized, and now we're doing the realized, right? So the amortized cost, we sell it for 150 minus the 98,750. So let me go back here. So that was at the end of year 1, 98,750 there in the middle of the far right column. So you take the difference between those two. So there's the gain, 56,250, and then profit and loss. All you do is take the 155 minus the 150. So there's the $5,000 recognized gain. And then you do the same thing under other comprehensive income. So you do, look, the 155 minus the 150, but then remember, let me go back here real quick. Remember on the bottom right there, we reported that over there as the unrealized gain on the bottom right of the income statement. So here we need to throw it in here. So there's the 56,250. Once again, that action word is to describe and not compute, but clearly if you go through this simple math and you'll be able to replicate this, you'll be able to answer any question about the describe. All right, how about moving on to accounting for investments in associates? All right, significant influence, but not a controlling interest. We said this before. 20% and 50%. Between those two ownership percentages, we're going to need to use the equity method, which tells us what? They're categorized as non-current assets on the balance sheet. You know, let's just go ahead and say the obvious, right? A current asset would be one that you would hold and you would think that you might be able to sell it sometime soon. But here, this is something that is a non-current. So I'm guessing the implication here is that, that non-controlling interest that we talked about up in that first circle point means that we're going to do this in a non-current basis, so multiple years or whatever. Initially recorded at the cost, and then we do some proportions on the income statement, and this will show up as a single line item. There it is on the balance sheet, and of course, if we receive any dividends on this, these are treated as a return on capital, which should make perfect sense, right? We're not going to report those as a profit or loss because, what does this mean? We have influence, but not a controlling interest. And so the influence part of there, even though we don't have control, the lack of control doesn't prevent us from viewing this as a return on capital. And so that recorded investment value, that makes perfect sense, right? We're going to take the initial cost and then add the difference between what the firm earned and how many dividends we received. Look at that bottom point there. Investor pauses the use of the equity method when the value of the investment becomes zero. That makes perfect sense. Let's go ahead and look at just a quick example. Let's suppose we've got a company purchases 25% for $500,000. And this company B has 3 years worth of reported income. So there's 500, 550, and 600. If you sum those, that's 1.65 million. And then dividends paid, 125, 175, and 225. And they sum to 525. So how are we going to put this on company A's balance sheet because it's an investment in associates? Well, we're going to record it as the 500, right? We initially invested 500, but then over time, what happens? Well, company B, they generate some income and they pay us dividends. So we're just going to take the difference between those two, 1.65 million, and the sum of the dividends, 525,000. And then we take 25% of that. So that gets us up to, what is that? 781,000. So that would be at the end of 2020. And so you get the sense here, accounting for investments in associates, it's based on, of course, it's based on the initial investment, but then it's based on, boy, you ready for this? I learned this from reading and rereading Modigliani and Miller back in 1958. So it's the initial investment plus a measurement of the improvement in the quality of company B. And of course, that has to be adjusted by dividends and the percent of our original investment. So you have the 500 plus another 281,000 over 3 years, and this should make perfect sense. How about goodwill? If you guys have looked at the actual reading here, goodwill is mentioned in several different spots. I remember my professors in graduate school mentioned goodwill, just of course when we were talking about mergers and acquisitions, but we had no conversations about the accounting treatment of goodwill. But I always give students this example, and I'm going to adjust it a little bit for you guys. You've seen me raise my calculator here for examples, in many of the videos back in level 1 and so far in level 2 as well. This calculator, what could you buy this 12C for? $100. I mean, I got this back when I was in graduate school. So this calculator's, probably 30 years old. But let's just suppose, and this is not a great example, but it's going to give you an illustration of goodwill and what we're trying to do to account for goodwill. Let's suppose that for some reason I'm standing with my calculator outside of the building where level 2 exam is going to be administered. And you show up in your car and you park in the garage and you have all your stuff and you look through and you have lost your calculator, or you have left it at home, or it fell out of the window as you were driving down the highway. All right, so what do? You need a calculator for the exam. And I'm standing there and I say, hey, this calculator's for sale. And there's no one else around it. And the bells are ringing. The exam begins in 5 minutes, right? So I look at you and I say, all right, this is worth $100. How much will you pay for it? And, like Chevy Chase in Vacation, when he had to get his car fixed, and he pulls all this money out and the guy just takes it all, right? So I'm going to say $1,000. So you pay me $1,000 because you're desperate for this calculator. Forget about the ethics or the morality of it. All right, so let's also suppose that I'm a company and you're a company and we try to report all this. So forget about me. It doesn't really matter what I report this on. But what are you going to do? Are you going to report this on your balance sheet as a $1,000 asset? Well, of course not, because it's only worth, let's say, $100. But you have to account for the fact that you paid $1,000 for it. So somewhere in there is goodwill. And then, of course, that you're going to have to write down that goodwill, because as soon as you leave that test, your calculator is no longer worth $1,000. All right, so let's think about how we're going to compute this goodwill. So here's a good little equation, and we have an example here for you in just a second. So we're going to take the purchase price and we're going to subtract some stuff, and that stuff represents the book value. Well, who knows what the book value of a calculator is. And then what we're going to do is we're going to subtract a couple of more stuff as it relates to property, plant, and equipment, and land, which probably doesn't have anything to do with the calculator. And then we're going to get a number down at the bottom, and that's going to be goodwill. And then I want you to look at this here. And so look, there's book value, there's book value, and there's book value in there. And so what happens if you're a company in which the value of your assets is declining because there's no demand for your product? So market value and book values, they do this. I mean, here's book value and market values do this. And so, at some point, market value is going to be less than the book value. And of course, you have to write down your goodwill. And there's that concept of impairment. So here, impairment, right? There's the $1,000 versus the $900. All right, so let's look at just a quick example here. Company A acquires 20% of the outstanding shares of Company B. All right, so there's Company B's assets and liabilities here, book value and fair value. So current assets, so they're both 20, that makes sense. Plant and equipment 20 and fair value 230, land 140 and 160. And so net assets are 160, fair value, net assets, book value 160 and fair value 210. So figure out the goodwill for this. All right, so let's go ahead. This is why we put some colors in here. So let's do this. So purchase price 200, right? We got that at the bottom, 20% of whatever number that is. So that's 200,000. All right, so let's subtract our percent of ownership, which is 20%, times the book value. All right, so let's go, whoops, I went the wrong way. Let's go back here to the bottom of the column, middle column, book value. There it is in green. There's the 160. So we take 20% of 160. So we subtract the 32 and we get the 168. Then we need to take into account the differences between plant and equipment and land. So we're going to take 20%. So notice there's 20% in the far right column there under both rows. But under the plant and equipment, we're going to multiply it by 30,000. So let's look at the red, right? There's the 200 and the 230. So there's the 30,000. And then look in purple, 140 and 160. There's the land. So there we go. 20% of 30, 20% of 20. So that's 6 and 4. So you do all that and you get 158,000 for goodwill. Look at the bottom box down there. Remember that you don't amortize goodwill, but you can impair. You can impair the goodwill. Think of my calculator. All right. How about if we move on to joint ventures? Now, both the International Financial Reporting Standards and GAAP, they require the equity method of accounting. And what this means is that there's going to be a single line item on the income statement, a single line item on the balance sheet. And here's one for AstraZeneca. Notice this is the income statement. There's one line, and then I'll go to the next slide. There's the balance sheet, and there is one line as well. So there's evidence of the one line. So the reading actually mentions this multiple times. And so that's probably important to remember. Equity method results in a single line item on both income statement and the balance sheet. Now, what did I say earlier? Let me just go back here quickly. Equity method of accounting for joint ventures is required. So, all right, we know that. However, there are some rare circumstances under which a joint venture might use proportionate consolidation. And so what's going to happen is that there's going to be the assets and the liabilities and the income and the expenses can be shown on a line-by-line basis with similar items. And this is in contrast to the equity method. Now, of course, both methods are going to result in the same total income recognized and same total net assets. And that makes perfect sense, right? I mean, you wouldn't want these two different methods to result in very different outcomes. However, because we're doing line by line, ratio analysis might be different. How about business combinations? Look down in the fourth circle point to start really quickly. So you can have a merger where you have company X plus company Y. That equals company X, but it's a bigger company X, right? An acquisition, you have company X and company Y, and that equals company X plus company Y. And then a consolidation, company X and company Y, and that's just another bigger company, but it has a different name. Business combinations involved two or more entities into a larger economic entity. I implied that with the X's and the Y's and the Z's. Motivation is expectations of added value through synergies. Oh my gosh, I have to scratch my head here going back to all of what I learned in graduate school about motives for mergers and acquisitions. Of course, everyone says 1 + 1 = 3, and we rely on synergies like revenue enhancements and minimization of costs and maybe some tax synergies and maybe some other kinds of synergies. And there have been lots of academic studies that have been done over the years that suggest that, oh my gosh, some of these synergies, they actually occur. In fact, many of them occur. However, are you guys aware that the average takeover premium in the merger market is, 40 or 50%? And so you think about the synergies. These synergies have to be massive to turn these acquisitions into positive net present value projects. So synergies work, but the question is, how much do you have to pay for them? And then, of course, that swings back to our conversation about goodwill. Third circle point there, no distinction among business combinations. That's important. And at the bottom, we're going to use the acquisition method for both GAAP and IFRS. All right, a couple of details about this acquisition method. Assets and liabilities are reported at fair values. I mean, that makes perfect sense. An acquirer is not required to accumulate 100% of the target to exercise a controlling interest. Remember, this is just 51% or above. parent-subsidiary relationship. Of course, both of these organizations, both of these companies have to prepare their own individual financial statements. But of course, the parent company then is going to combine all the stuff that they get in those financial statements with its own. And then this is the first time I learned this back in my undergraduate days about double counting. I mean, of course, everyone knows this from kindergarten. If you have one apple and two apples, you have three apples, right? But you don't want to extra count. You don't want to double count. That's why you learn counting in kindergarten. But the first time I learned of the financial consequences of double counting really was as an undergraduate student. You don't want to count it here and count it over here. And so we're going to exclude intercompany transactions. Now, how about a non-controlling interest? All right, so the portion of the subsidiary's equity not owned by the parent is computed in the following way. So look at this. Our non-controlling interest, the percentage of the subsidiary not owned. So remember, this number is going to be less than 50% times the sub's equity. And that should make perfect sense there. Reported as a separate component. And this method, this part of the acquisition method results in higher revenues and expenses relative to the equity method. But, of course, net income has to be the same under both methods. All right, how about these special purpose vehicles? Non-operating entities created to meet the specific needs of the sponsoring entity. All right, so that makes sense. We can go all the way back to Enron. Enron created, I think hundreds of these, maybe at least 100 of these things to place some kind of assets in this non-operating entity to do something, and that to do something means, maybe to raise capital, maybe to diversify, maybe to maybe in Enron's case, maybe to hide assets, maybe to hide assets that weren't quite as valuable as they told us that they were, et cetera, et cetera. Now, in the old days, sponsors could avoid consolidating these because they did not have control of them. So this way, sponsors did not have to report the assets and the liabilities of this special purpose entity. Look at that fourth circle point there. The sponsoring company would show improved asset turnover, lower operating and financial leverage, and higher profitability. So that, that middle one there, lower operating and financial leverage, is probably the important one. And there's Enron there at the bottom. Obtain off-balance sheet financing and artificially improve its financial performance. Its subsequent collapse was partially, maybe substantially attributable to its guarantee of the debt of the SPs that it had created. And of course, this is not a problem. I mean, Enron, if you associate Enron with special purpose vehicles, that's really not fair to special purpose vehicles because in and of themselves, they are not inherently good or bad. They were designed and engineered to fulfill a certain promise. And as I've said multiple times in videos over the years, that's fine. Do all this, but then just report it. Transparency is critical. If you're putting them over there in this special purpose vehicle to hide, which is probably what Enron tried to do, then that's not fair to the rest of us. All right, so let's look at the differences here. So under IFRS, the SPE must be consolidated if the substance of their relationship indicates control. Under GAAP, the sponsor must consolidate it as a subsidiary regardless of how much equity investment it has. Now, this variable interest entity is one in which there's financial control by one or more parties, and that's the nature of the variable interest term. Here's a good summary page of a table of what we just described over the last handful of minutes. I would copy and paste this slide somewhere. In fact, what I would do. Now I couldn't do this when I was studying for this stuff, but now I would get my phone out and take a picture of that, and I would just put it in my phone. And instead of playing Candy Crush, I would get this out and memorize, and I'd, knowing me, I'd probably have 1 million of those pictures for level 2. Anyway, anything to help us pass. All right, how about an LOS that asks us something different? So here we go, distinguish with all this stuff. So we're comparing GAAP and IFRS 17. So there's this fair value option. So this is an option to recognize an equity method investment at fair value at the time of its initial recognition. And so under IFRS, this is only available to venture capitalists and unit trusts. But in Connecticut GAAP, right, this is available to all entities. Calculator impairment. All right, the equity method investments require periodic reviews for impairment. It occurs when the carrying amount exceeds the fair value. All right, so clearly you're not carrying this calculator at $1,000. All right. So under IFRS, impairment needs to be indicated by at least one loss event. But over in the GAAP, the investment is written down to fair value and the loss is recognized over on the income statement. Now here's one of the interesting things about impairment. Notice that last sentence, the reversal of permanent impairment losses is prohibited, which means that you are never going to get this back. In other words, you can never expect to sell my calculator, which I sold to you for $1,000 or more. The two organizations have different definitions of joint ventures. IFRS classifies joint ventures as, you ready for this? Jointly controlled operations, jointly controlled assets, and jointly controlled entities. So we've got to do consolidation here. Of course, it's proportionate. Under US GAAP, joint ventures are jointly controlled separate entities. And so you use the equity method there. So that key difference there is in US GAAP, separate entities. Business combinations, acquisition method for both. Goodwill. This is where you bring in the concept of partial goodwill, which is under IFRS, but US GAAP recognizes it as full goodwill. Now remember, the LOS is just describe, not compute, but for those of you who love the math, and I think it's worth it too, looking down at the note at the bottom, partial goodwill, purchase price minus fair value of those identifiable assets, right, times the percent owned. That's the partial goodwill, but full goodwill is the fair value of the equity of the entire subsidiary minus the fair value of those identifiable net assets. So partial goodwill and full goodwill, I would make sure I know the difference just as it relates to this LOS where you're describing the differences. All right, back to those non-controlling interests. All right, so the portion of the subsidiary's equity not owned by the parent when the acquirer holds less than 100%, right? That makes sense. So IFRS allows the non-controlling interest to be measured at fair value or at proportional share. So full value or full goodwill or partial goodwill, but US GAAP is full goodwill. Let's see, I think I've said a bunch of these things about goodwill in the last few slides. Not amortized, but tested for impairment, right? Goodwill is impaired when the recovery value is less than its carrying value, right? That's important. Goodwill is impaired when the carrying value of a business unit exceeds its fair value. So notice those subtle differences between the two. More differences here. US GAAP companies use historical model, but IFRS, property, plant, and equipment, either historical or fair value. And there are some good formulas there. I'm guessing you probably remember those from level 1. Boy, am I going to get my camera out and take a picture of that? I'm not quite sure. I think we know enough to memorize those. Under IFRS, SPE must be consolidated if the substance of the relationship indicates control. We said that already. Under GAAP, the primary beneficiary must consolidate it as a subsidiary regardless of how much equity it has. Here's another slide, and here's another one too. So these two slides, let's get your cameras out and take a picture. So this is the last LOS, right? Analyze how different methods will impact financial statements or ratios. So notice, the first, 4 or 5, there's impact on financial statements. So under equity, proportionate, and acquisition methods, so I would just memorize those things. And then there's some ratios there as well. And here are some more ratios. And I believe that takes us through those 3 LOSs. Remember, that first one is by far the super most important.